Look at this network. For any mechanical trading strategy, the absolute baseline requirement is simple. The system must survive the long term. Survival is not a matter of luck. It is dictated by the systematic elimination of concentrated points of failure. In mechanical terms, we define correlation as different assets and variables moving and ultimately failing together. To visualize these vulnerabilities, we use a two-dimensional risk matrix. The y-axis tracks asset diversification, while the x-axis tracks time diversification. Decoupling capital along both of these distinct intersecting axes creates a portfolio structure that does not rely on a single favorable outcome. Most retail traders only attempt to solve for one of these dimensions, leaving the entire system exposed to a failure on the other. Mapping risk across this matrix allows us to identify where capital is bunched together, providing the framework to isolate systemic threats before they occur. We begin with the y-axis to analyze the first dimension of risk, asset correlation. The common trap for retail investors is the decision to hold individual stocks. This cluster of nodes, plotted low on the y-axis, represents a portfolio of individual tech stocks, accepting massive single-company risks like a sudden CEO firing. Because they react to the same events, a sector downturn causes every node to fail simultaneously. The mechanical solution is to move away from individual companies and trade a broad market index, such as ES futures. Trading the index shifts your position to the aggregate strength of the top 500 companies in the U.S. economy. By moving high on the y-axis, you decouple your money from localized corporate failures, effectively removing bad company risk from the equation. Now we pivot to the x-axis to examine the second dimension of risk, time correlation. Diversifying what you buy is only half the solution. You must also diversify when you buy it. Consider the Tuesday trap, where an investor deploys their entire cash balance into a position at a single point in time. This deployment ties every dollar of the portfolio to the exact same entry price and the exact same volatility environment. It creates a singular point of failure, tying your capital to a shared expiration date. If a sudden market shock hits shortly after entry, the portfolio is caught in the storm simultaneously. With no temporal separation, the entire portfolio takes the maximum hit. Even with perfect asset diversification, a portfolio remains exposed to 100% loss from a single bad market day if time correlation isn't addressed. To solve the time correlation trap, we establish a strict daily speed limit. This rule limits capital deployment to a measured percentage of your total RESV each day. By staggering your entries, you break a single large block of risk into smaller, manageable fractions. This forces your capital to spread out across the time dimension, rather than clustering on a single afternoon. As a result, your active trades inherently possess different entry prices. They also possess different staggered expiration dates. Staggering entries converts time from a concentrated point of failure into an active, diversified layer of protection. The daily speed limit ensures that no single market event can intersect with the entirety of the portfolio's active risk. Here is the optimized 2D risk matrix: high y-axis placement through index exposure and wide x-axis distribution through staggered entries, supported by distinct cash reserves. If a market shock hits on a Monday, the damage is structurally contained. Tuesday and Wednesday remain insulated. The loss is strictly confined to the small percentage of risk deployed for that specific day. Meanwhile, the cash held in reserve is perfectly protected, ready to capitalize on the new market pricing created by the shock. Managing correlation across both axes ensures that a mechanical strategy is built to endure the market cycles that destroy concentrated portfolios. Eliminating asset correlation protects you from bad companies. Eliminating time correlation protects you from bad days.